What if you had to lock $50,000 into only 10 stocks today and then walk away for 25 years? No tinkering, no panic sells, no victory laps. I'm Mark. This is Dividend Hustle, and I'll be honest. I've blown money chasing screenshots and thumbnails promising 140% annually of insane. It felt exciting, right up until I was wide awake at 2 a.m., refreshing my phone and second-guessing everything. Freedom was the dream. The portfolio I built was a death trap. Here's the uncomfortable truth. Over long stretches, a tiny sliver of companies creates most of the market's wealth. Miss that sliver, and decades of saving can end up as just okay. Hit it, and time starts compounding in your favor. More choices, less stress, and a life that isn't chained to a stock app. So today, I'm putting my own skin in the game. If I had to invest $50,000 into 10 set it and forget it names for 25 years, these are the companies I choose. And why? I'll show you the real events that made them durable. Pivots, moats, cash flows, the risks that could break them, and the simple rules I use so my future self doesn't hate me. By the end, you'll have a calm, repeatable framework to build your forever list and the confidence to leave it alone. Ready? Let's earn your freedom the boring way. Okay, here's why your future self will thank you. Picture two versions of you at 50. One quietly coasts because your money compounded in world-class businesses. The other is still hustling overtime because a few flashy picks flatlined. Here's the hard math. Over long stretches, a tiny slice of companies creates most of the market's net wealth. Miss too many of those winners and your freedom fund turns into just okay. And one wrong pick isn't just a bad day, it's an opportunity cost that haunts decades. If $10,000 compounds at 8% for 25 years, it becomes about $68,000. If that same $10,000 sits in a loser that goes nowhere, you didn't just break even, you forfeited roughly $58,000 of future choices. That's vacations you don't take, a house down payment you don't have, or time with your kids you can't buy back. Set and forget beats busy trading because it removes the impulse to fix what isn't broken and lets time do the heavy lifting while you live your life. Before we go further, these are the rules that keep you safe. First, moats. We want businesses with defenses you can explain in one breath. Network effects, more users make it better. Switching costs, too painful to leave. Brand power, trusted and top of mind. Or unique assets, licenses, patents, irreplaceable infrastructure. Second, ROIC, return on invested capital. High, durable ROIC tells you management isn't just growing, it's compounding every new dollar at attractive rates. Third, gross margin durability. A decade of steady or rising gross margin says the company can raise prices or hold costs while competitors fight in the gutter. Fourth, balance sheet strength. Cash and low net debt keep companies playing offense in recessions while weaker rivals sell assets and talent. Fifth, recurring cash flows. Subscriptions, usage-based software, payments toll roads, membership models, predictable money that funds buybacks, R&D, and dividends. Finally, real-world resilience. Can the business keep marching through tariffs, regulation, tech shifts, and supply shocks? Forever stocks aren't fragile, they flex. Let's map this out. My 3-bucket plan for the next 25 years. I split a forever portfolio into 3 buckets so I sleep at night and still capture upside. Bedrock holds the sleep easy names. Dominant brands, recurring revenue, fortress finances. They won't always be exciting, but they protect the plan when markets act dramatic. Flywheel names are secular growers. Platforms that get stronger as they scale, with expanding cash flows and reinvestment runways. They compound faster, but you accept some volatility as the price of progress. Moonshots are measured bets with asymmetric upside, small position sizes in breakthrough tech or category creators that could 5 to 10 times over a decade if execution meets the science. The mix keeps you from overbetting the future or anchoring in the past. Stability from Bedrock, compounding from Flywheels, optionality from Moonshots. Quick story time. From comparison trap to calm compounding. A few years back, I was stuck in the comparison trap, chasing someone else's screenshot, swapping tickers every time a thread went viral. My portfolio looked busy, but it wasn't building anything. The turning point was boring. I wrote a 1-page plan using these rules, picked businesses I could explain without a chart, and automated the rest. Months later, I noticed something new. Silence. Fewer notifications. Fewer knots in my stomach. The numbers weren't lurching, they were climbing. That's the calm of real compounding, not the rush of a hot pick, but the confidence that your next 25 years are already in motion. Now, how I actually picked these, no hype, just data. I kept it simple. long-term charts to see who compounds across cycles, cash flow statements to confirm those curves aren't just storylines, and real events or pivots that show management can adapt. Cloud transitions, platform turns, mission-critical adoption. If a company's returns on capital stay high while margins hold or improve, and if cash reliably funds R&D, buybacks, and dividends without balance sheet gymnastics, it made the shortlist. I'm okay with measured risk when it's paid for by durable advantages, so you'll see a moonshot or two, but they're sized to never sink the ship. The outcome is a list I'd be comfortable handing to my future kids with one instruction: add, don't tinker. The fun part: let's count down the Forever 10. Kicking off at number 10, Microsoft, my Bedrock pick. Why it wins. A once-in-a-generation pivot from boxed software to cloud subscriptions, now layering AI into products people already use daily. Real-life proof. Azure and Microsoft 365 turned revenue into a utility-like stream, while Copilot is a paid upgrade path inside an enormous installed base. Set and forget risk check. Recurring revenue, fortress balance sheet, and wide distribution across enterprise, consumer, and gaming. Reduce single product risk. What could break it? Antitrust remedies that limit bundling, AI price wars compressing margins, or a major platform shift that weakens Windows/Office gravity. Next up, number 9, Google, the flywheel you already use daily. Why it wins. Search, YouTube, Android, and a strengthening cloud business create a data and distribution flywheel few can match. Real-life proof. The company has repeatedly absorbed platform shocks, mobile privacy changes, and found new monetization, YouTube Shorts, cloud, profitability, while Waymo proves long-cycle R&D can surface as real services. Set and forget risk check. Multiple engines, ads, cloud, YouTube, and a cash-rich balance sheet to fund moonshots. What could break it? Regulatory remedies that reshape search ads economics, AI answers reducing query monetization, or under-monetization of emerging products. Rolling to number 8. Amazon, the Prime plus AWS engine. Why it wins? The Prime Logistics plus Marketplace plus AWS stack compounds because each layer reinforces the others. Real-life proof. Same-day, next-day delivery density improved conversion and seller dependence. AWS remains a default for enterprises while Amazon infuses AI across retail and cloud. Set and forget risk check. Diversified engines, retail, ads, cloud, plus relentless cost discipline. Historically gains share in slowdowns. What could break it? Margin pressure from retail price competition, regulatory actions around marketplace practices, or a cloud platform shift that favors competitors. At number 7, NVIDIA, the picks and shovels of AI. Why it wins? Owns the critical picks and shovels for AI training and increasingly inference, with a hardware-software ecosystem, CUDA, networking, that locks in developers. Real-life proof. Data center revenue inflected with generative AI, and the company has expanded into networking, software stacks, and specialized platforms beyond gaming. Set and forget risk check, deep R&D engine, partner ecosystem, and demand from hyperscalers and enterprises. What could break it? Supply normalization and competitor catch-up compressing pricing, export controls, or a paradigm shift to alternative accelerators. Halfway there, number 6. Visa, the global toll road. Why it wins. A toll road on global commerce with powerful network effects and minimal credit risk. It's a network, not a lender. Real-life proof. Decades of volume growth as cash digitizes, expansion into real-time payouts, Visa Direct, tokens, and new flows. Set and forget risk check. High margins, resilient through cycles, and benefits from secular tailwinds. E-commerce, contactless. What could break it? Fee regulation, closed-loop challengers gaining share, or faster-than-expected shifts to alternative rails that sidestep the network. Top 5. Number 5, Mercado Libre, LATAM's everything stack. Why it wins. The everything stack of Latin America. Marketplace plus payments, Mercado Pago plus logistics plus credit in under-penetrated markets with long runways. Real-life proof. Users graduate from buying to using digital wallets, paying bills, and borrowing. Each step tightens the ecosystem. Set and forget risk check. Multiple profit pools, improving logistics moat, and secular shift from cash to digital. What could break it? Credit losses during recessions, regulatory changes in payments/fintech, or aggressive regional competitors subsidized by external capital. Taking a measured swing, number 4, INAQ, the Moonshot slot. Why it wins. Trapped ion architecture targets high-fidelity qubits and all-to-all connectivity, an approach designed to reduce error correction overhead as systems scale. Real-life proof, accessible via major cloud platforms and steadily improving algorithmic capability. Early commercial pilots point to practical workloads over time. Set and forget risk check, tiny position sizing, potential multi-decade upside if the tech curve keeps compounding. What could break it? Scientific or engineering roadblocks, slower commercialization, or rival architectures, superconducting/photonic, achieving scale first. Into the podium, number 3, Costco, the membership machine. Why it wins, a membership model that turns customers into owners of the experience. Low margins on goods, strong loyalty, and steady foot traffic. Real-life proof, renewal rates that rival streaming services, Kirkland scale, and disciplined expansion that rarely misses. Set and forget risk check, predictable cash generation across cycles, pricing power via trust rather than markups. What could break it? Membership fatigue if value perception slips, supply chain shocks that disrupt in-stock reputation, or missteps in digital integration. Runner-up, number 2, CrowdStrike, security you only notice when it fails. Why it wins, cloud-native cybersecurity with a single lightweight agent and an expanding module ecosystem. Every breach headline makes the platform more mission-critical. Real-life proof, customers land with one module and expand across dozens. Strong net retention reflects must-have status. Set and forget risk check, recurring subscription revenue, high gross margins, and embedded partnerships with major clouds. What could break it? A high-profile platform failure, margin pressure from bundled security competitors, or shifting regulatory standards around data and AI. And at number 1, Palantir, where Flywheel meets Moonshot. Why it wins, software that fuses messy real-world data into operational decisions at scale for governments and enterprises. AIP aims AI at concrete outcomes, not demos. Real-life proof, adoption in defense, healthcare, energy, and manufacturing. Expansion from government into commercial driven by time-to-value deployments. Set and forget risk check, sticky contracts, rising operating discipline, and a large pipeline as AI budgets move from experimentation to production. What could break it? Procurement cycles that elongate, perception-driven valuation swings, or competitors narrowing the gap on deploy-fast, outcome-driven platforms. Quick reality check. Compounding dreams versus gut-punch drawdowns. The dream is simple. Let time do the heavy lifting. At an 8% annual return, $50,000 becomes roughly $342,000 in 25 years. At 10%, it's about $542,000. That's the quiet power of compounding. Money earning on money while you live your life. The reality is less Instagrammable. Even world-class companies can drop 40 to 70% along the way. Both can be true at the same time. The price of decades of calm compounding is surviving a handful of brutal drawdowns without blowing up the plan. That's why we choose businesses with moats and cash engines, size our risks sanely, and commit to process over headlines. You're not trying to avoid storms. You're building a ship that keeps sailing after them. Myth-busting minute, 4 ideas to flip. ETFs always beat individual stocks. ETFs are a fantastic default because they guarantee you own the winners you can't predict in advance. But disciplined ownership of a few dominant, cash-rich, high ROIC franchises can outpace broad indexes over long horizons, if you actually hold them through the ugly parts. Most people don't. Our approach borrows the ETF's patience while concentrating on businesses we can explain in one breath. Dividends are the only safe return. Dividends are great, predictable cash paid to you, but the safest driver of long-term wealth is durable free cash flow and smart reinvestment. Many elite compounders deliver the bulk of returns via growth and buybacks, not just yield. We want total return with a margin of safety, not yield, for yield's sake. Tariffs/regs kill tech. They can pinch margins and slow certain lines, but resilient platforms adapt. Software-heavy, subscription-driven businesses often have insulation from tariffs. Regulatory pressure is real, yet the strongest operators usually absorb fines, change practices, and keep compounding. Our picks emphasize adaptability and multiple profit engines, not single-point fragility. Set and forget equals never rebalance. Set and forget means no tinkering for entertainment. It does not mean neglect. We do an annual rules-based review. Thesis intact? Moat/ROIC/margins holding? Balance sheet still strong? If a name breaks the rules, we upgrade the slot, tax-aware and infrequently. It's stewardship, not fidgeting. By the way, how my list stacks up to Eli's and Joseph's, where I overlap with Eli, dividendology. We meet on three names: Microsoft, Visa, and Costco. No coincidence, they score high on moats, ROIC, and gross margin durability, with balance sheet strength and recurring cash flows. That's the sleep-at-night core both of us want. Where we diverge. Eli leans further into classic wide moat staples like MasterCard, ASML, Broadcom, Canadian National Railway, Waste Management, and JP Morgan. Phenomenal operators with durable economics and, in many cases, steady dividend growth. I kept those qualities but tilted more towards secular tech platforms and one measured moonshot for asymmetric upside. Same philosophy, different flavor. How Joseph Hoag's AI tilt complements a forever list. Joseph's basket skews toward AI, infrastructure, and automation. Think Dell, Marvel, Supermicro, Symbotic. That slate can complement our Bedrock/Flywheel core by adding exposure to the hardware, networking, and warehouse automation layers powering AI at the edge. If you pair his AI picks, sized modestly, with our Bedrock foundation, you keep the portfolio's spine sturdy while still catching the next leg of compute growth. All right, here's your $50,000 game plan. Step by step. If the money is already sitting in cash and you know you'll freeze up if headlines turn ugly, split the difference. Put 50% in now and dollar cost average the other 50% over the next 6 to 12 months. Lump sum usually wins because time in the market beats perfect timing, but DCA buys you peace of mind. And peace of mind is what keeps you invested. For allocation, I keep it simple across our three buckets: Bedrock 50%, Flywheel 40%, Moonshot 10%. On $50,000, that's $25,000 spread across Microsoft/Visa/Costco. $20,000 across Alphabet, Amazon, Nvidia, Mercado Libre, CrowdStrike, and Palantir, sized by your conviction. And $5,000 in IonQ as the measured asymmetric bet. Then set annual check-in rules. Once a year, same week, you ask 5 questions. Has the moat narrowed? Is ROIC holding up? Are gross margins stable or rising? Is the balance sheet still fortress level? Is recurring cash flow growing? If 2 or more fail and it's not a temporary cycle issue, upgrade the slot to a stronger name rather than hoping. That's stewardship, not tinkering. No BS toolkit you can use tonight. Think in 3 lifestyle frames to set your savings rate and stress level. Lean means a higher savings rate for a focused burst, 30 to 40% for 3 to 5 years, to front-load compounding. Coast means you've funded enough early that normal contributions keep you on track. Your investments do most of the lifting. Barista means you intentionally keep a flexible income stream or side hustle that covers living costs while your portfolio compounds. Use whichever keeps you consistent. Now automate. Set an auto transfer on payday. Auto invest into your 10 tickers per your target weights. Turn on dividend reinvestment. Calendar a 30-minute quarterly review. And write a 1-page investment policy. Your 5 rules above. Keep a red flag trigger list so you act on facts, not vibes. 2 consecutive years of margin or ROIC deterioration, leverage spikes with no clear payoff, serial dilution to fund operating losses, customer concentration rising while growth slows, accounting restatements or abrupt CFO exits, regulatory changes that permanently cap pricing networks, slash payments, or ban key products. Any 2 triggers? Review, and if needed, upgrade the slot. Before we wrap, your promise to future you. You're not playing days, you're playing decades. The plan is calm on purpose. Own durable engines, size risk like an adult, and let compounding do what adrenaline never will. This isn't financial advice, it's the exact blueprint I'd hand my kids if they asked how to buy back their time. Your move. Drop your number 1 forever stock and share this with a chronic overtrader. Now it's your turn. Comment your number 1 forever stock and why. I read every take. If this gave you clarity, like the video, subscribe for the follow-up deep dives on each pick, and share this with the friend who can't stop overtrading. Let's build freedom the boring way, together.